Welcome everyone to tonight's webinar. I'm just starting a few minutes late here. As you can see, we're going to go into trends. So again, if you're unfamiliar with this webinar series, my name is Brian. I have a boutique trading and investing consulting service. And the reason why I titled these Back to Basics is because as you'll see, as we get into some of these intermarket relationships that I concentrate on, as we get into some of these currency pairs, as we talk about stocks, and again, those relationships, you will see that a lot of charts or a lot of entities, I guess, are doing their own little thing. And so we can't rely sometimes on these relationships. Those relationships help us when they're in line, but sometimes they're not in line and they're not working, and so that's just as helpful to us. So that's why it's called Back to Basics, because we're going to cover a little bit of trading psychology, we're going to cover fundamental analysis, we're going to cover technical analysis. It's all going to come together, and again, this is a series that's been built on top of each other every couple of weeks. So if you haven't been involved in this in the past, this is my 7th webinar with Interbank FX, so there are webinars to catch up on and make sure that you are focusing on basics. And again, basics probably also has a dual meaning because it really talks about who you are as a trader, and I'm really big on that on the psychology, is talking about who the individual is, what can they afford to risk, what kind of time frame do they have to trade given their lifestyle, commitments to work, family, things like that. So back to basics really means digging down deep, looking inside and saying, what can I achieve, and making sure that you're good at filtering out a lot of the information out there. 90% of the information may not be relevant to you as a trader. It all depends on where you're at. Sometimes I deal with people who are fully invested and I'm playing defense. Sometimes I'm dealing with people who are young and haven't built up those portfolios, or sometimes people just don't trust the markets and they're not invested, and so I don't have to work on defense. So I've got to do a good job of mirroring my clients and finding out who they are and working with them to get the most out of their needs and also their resources. So just be true to yourself and make sure that you're getting the most out of you as a trader, as an investor, and then applying your strategies and styles into the markets there that work for you. So that's my email. You're welcome to email me. My blog, I just updated the blog there. That's at the bottom. I updated it yesterday. I didn't update it today. I updated it yesterday, and I want to lead in with that right away. Before I go ahead and lead in with that, though, let's get this out of the way. This disclaimer is very, very, very important. Again, you're trading leveraged products, and you know how quick they can turn. You know that news and worldwide events can change them. So we want to make sure that we always have trading plans. So I'll just let you read that. As you're reading that, again, the questions tab is where you want to go ahead and type in any of your questions. Please, please, as soon as something comes up that you don't understand, that you want to look at in more detail, whether it's a foreign currency pair, whether it's a relationship, whether it's a question about the platform, please let me know. I may answer it right there if it makes sense for what I'm talking about. I may hold off and answer it later because I might get to it. You might have been just a little bit ahead of me. I might say, you know what, catch up on me via email because that's something more pertinent to you as an individual versus the content that I'm on and the group tonight. So please, please go ahead and use that questions. I'll pause once in a while and I'll go back in there and I'll make sure that I try and answer all of those questions. So use that tab again. I can send out a message to all of you via chat, but you guys, it seems the past few webinars that it's been working if you guys use that question tab. So the outline for tonight, we're going to talk about fundamental analysis, we're going to talk about technical analysis, and then we'll get into defining a trend, and we'll talk about that trend for a intraday trader, a short-term time frame, as well as a longer time frame as well, and look at some good examples. But again, like I said, before I get into everything, I just want to mention what I wrote about on my blog yesterday. I talked about the differences between buying options and selling options. Some of you aren't option traders, but I think it's important because most of the people here probably have investments, and options are a great way to go ahead and hedge some of those equity investments in IRAs and 401ks and things like that. They can also hedge inflation. They can also hedge cost of goods if you have a business and things like that, coffee shops, trucking companies using lots of oil. and commodities. You can also obviously use foreign currencies if you understand those intermarket relationships that we'll go over. But I just talked about risk reward, so that's what I'm hammering on here as back to basics, as at the title, is always understanding the risk reward for whatever trading strategy you're doing. The other thing that I talked about is let the markets tell you what to do. So no matter what type of trader, investor you are, no matter what product you're trading, you've got to let the markets tell you what to do. And a big thing going on right now is the volatility gauge. And so I do want to go ahead and look at that very, very quickly. And for some of you who don't know how to look that up, you can go ahead and look it up on using the VIX, VIX, so Victor India X-ray. And the VIX basically is a fear gauge or uncertainty gauge. And right now, it's relatively low, meaning it's under that 20 level, 19 level, 18 level. You can see it right here. Right now, it closed at 1852. It went down a little bit today. Even though the markets went down today and caused a little bit more fear, I guess you could say, remember, we had a big unknown event, which was the Federal Reserve statement today and the Bernanke press conference. So when we have a known event become known, that takes a lot of the volatility out of it. So some of you own individual stocks. Some of you work for companies. Every quarter we have earnings for reports for those companies. Well, that's an unknown event. Then it comes out as a known event, and volatility usually drops. But the bottom line is volatility overall for the markets as a whole is low. And so that's what you have to remember as a trader. So you have to just remember, if you're a day trader, is the volatility out there and the movement out there that you need to go and bang, 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 bang on the mouse and make your trades? And so I was talking today with a client, and we looked at some longer-term trades or longer-term time frames, just because we understand that some of the ranges intraday are smaller. So that's something to be very, very aware of, is just what's going on overall with the opportunities for you depending on what type of trader you are. So you've seen it has climbed up overall. This is just a one-day chart, but I'll show you on, let's see, a 6-month chart. It has climbed up higher over the past couple months, and that makes sense because the markets have gone down. But overall, it's pretty low. This was that spike in March when the tsunami happened and the Japanese fallout there happened. So we're not as high as that by any means, obviously. That's a good thing. But overall, volatility, the lower it is, it means that ranges are smaller, intraday trading opportunities are a little bit smaller. Also, be aware of what time of year it is. We're hitting July 4th basically in about a week and a half here in America. The Europeans love their vacations. So you have to remember also that that can be a slower time for trading. Don't get me wrong. If there's some huge, huge, exciting international event, traders will come back from whatever beach they're at and whatever vacation they're at, and they'll come back to work. But the bottom line is you have to understand that things can get even slower, or things can get even less volatile, and this VIX can go 18, 17, 16, 15. Let's even look at it on a longer term time frame. There's the 1-year chart, and then this is the 2-year chart. So as the markets have rallied, this has stayed relatively low. This peak here is last summer when we fell off a little bit, but then we climbed to new highs. So again, it's relatively low. It is summer markets, or we're getting into summer markets. So you can't just come in and show up and say, I'm going to make a trade today. I'm going to make a trade today. You've got to let the trade come to you. You've got to let the markets tell you what type of strategies to put on. So that discussion all revolved around options. If any of you trade options, you can buy options or you can sell options. Buying options, you have to call the direction correctly in the market. Selling options, you have 3 ways to be right. The trade can go for you, the trade can go sideways, or the trade can go a little bit against you. And so we were talking about risk reward. It's normal to risk a little bit more to make less when you have 3 ways to win when you sell options. When you're buying options, you need the markets to move in your intended direction. That's the only way that you can make money. So you risk less to make more because you're saying, I believe the direction of the market is going to go here. For all of you Forex directional traders, you're either buying a currency or you're selling short that currency. And so you're calling the direction of the markets. So you'd like to have a risk that's smaller than your potential reward because you've made a trading plan due to this, this, and this. So again, here's the outline. Let's go right into fundamental analysis. It'll roll us right into technical analysis, and then we'll get into the theme for tonight. Fundamental analysis, let's discuss the current events. Let's do a catch-up over the past couple weeks. I mentioned earnings. It is an earnings period, so most companies out there are reporting over the next few weeks. Just as important as that is the big events out there. Ben Bernanke spoke today. The Federal Reserve talked today. So if you don't understand what they're saying, print it out. So you go to federalreserve.gov. It's a free website. Go to FOMC statement. Here it is. Hampton Pearson on CNBC today read it to us, but you can print it out a few minutes after, put it into a folder, and then what we're looking for in 6 weeks, if they don't change the interest rate, what wording did they change? So did they say inflation has increased? Did they say that unemployment is actually lagging even more? Did they say we're going to stop keeping rates accommodative for an extended period of time? So that word extended, keeping rates low for an extended period of time, has been in there month after month after month. I don't expect it to change too soon, but you never know. So print this out. Keep it in a folder. 6 weeks later, when we meet again, go ahead and print out that statement again when the FOMC meets. Other data coming out this week. It's a busy, busy week. So Wednesday, we had the Federal Reserve statement. That was the big one for today. And tomorrow, we get our weekly unemployment claims. If that number climbs, that's not good for the labor market. Obviously, that's not good for spending and things like that. So keep your eye on that tomorrow. Friday, we get our first big order kind of the new month, I guess you could say, durable goods orders to see how some of those big ticket items are doing. But fast forward to next week, and we have a lot of data next week. Usually the last week of the month and the first week of the month are the two busiest as far as the economic calendar goes. So Monday, not much going on in the United States. Tuesday, U.S. dollar picks up a little bit with consumer confidence. And let's see, Wednesday, we start to pick up even more. Home sales, crude oil, things like that. And then they cram it basically into Thursday and Friday. We get our unemployment claims. We got our Chicago purchasing managers, which if you remember a month ago was very bad as far as the headline number goes. The new orders component was bad. The employment component was bad. And that all kind of led into the unemployment data, which comes out every single Friday. So we'll see. Here it is, somewhere in here basically. So let's see. I think it flipped me to July, so I apologize. Let's make sure that we are on June. So here we go on Friday. So actually, let's see. I might be mistaken. Maybe we're skipping a week. Sometimes due to how many weeks are in between unemployment report, it sometimes isn't that first Friday of the month, and it can be the second Friday of the month. So it's actually now going to be on the 8th because there wasn't enough data in between, because June maybe basically was a shorter month, I guess you could say. So we're not going to get that till the 8th. But the bottom line is it's only about 10, 11, 12 trading days away. And that's a big, big report. So lots and lots and lots of data coming out in the next couple weeks. You guys have to be aware of that. Obviously, as foreign currency traders, you have to be aware of it as options traders and equity traders if there's an earnings report on a specific company or if there's a big report on our economy. Let me check back if there's any questions, and we're going to move into the technical side of things. All right, so we have a question coming in here. What's the difference between the VIX and VXX? And then another question, are your previous webinars with IBX available for viewing? Yes, I'll give you the YouTube site at the end, but yes, IBFX, once they go through compliance tonight, then they go ahead and pop them up about a week later on their Interbank FX YouTube site. So yes, you can find all of the webinars there. Like I said, there are 6 previous ones. VIX and VXX. VIX is basically the go-to, if you will, indicator for volatility, because it's basically tracking. There's kind of a complex component to it, but it has to do with at-the-money options, a certain time frame out in the S&P. So that's kind of what you're focusing on in the VIX. If we go to VXX, so those are going to, it looks like we're just going to be on the futures basically, so it should be pretty similar, but let's go ahead and pop up. I don't pay attention too much to the VIX as a whole, because bottom line is all I want to look at the number to know where it is, but the bottom line is if I understand that there's a lot of data coming out, if I understand that the markets are crashing, I know that volatility is going up. So it's not that volatility goes up and then the stock market goes, oh, volatility is going up, I'm going to go down. It's there's more fear and uncertainty in the stock market, and it goes down due to, hey, what's next? Maybe we're not having as good unemployment. And so that's basically your hedge, is if you think that the VIX is low and you're using it as a hedge, go ahead and buy calls on it or buy the stock, and as it goes up, you hope that the stock market goes down and fuels that move up in that volatility gauge. So the other thing to remember is whenever you're looking at variations, whether they're ETFs and things like that, like this, you just need to look at the volume and make sure that the spreads are close and things like that. So obviously this one has a good volume and it is very, very well tradable, but it's the short-term futures there, basically. That's the difference. So do some work on that. VIX is basically, what you hear on CNBC and stuff like that. Everything is tradable. Just make sure that you know the nuances of what makes it work. So like I said, VIX is just kind of the headline. But the bottom line is it's not moving first. It's moving in reaction. So you would use it as a hedge to protect what you think is impending doom or uncertainty or fear, and the market's rolling down and you're in it low, and then as a result of the market's moving down, you're able to sell it at a higher price because you bought it as protection. So that's the bottom line, how you would mostly use the VIX. But again, it's not something that I personally focus on constantly because I don't really look to trade it. There's other ways to hedge things that I think are cleaner. The VIX has so many inputs going into it that I don't think the trade is as clean. As you saw today, the stock market went down, but the VIX went down. So that would probably make sense because the FOMC is a big worrisome and worried statement. But the bottom line is the FOMC is transparent. They didn't say anything new for the most part. They didn't give us new information. So I wouldn't expect it to be an easy VIX trade if you're trying to trade the news announcement today on the Bernanke news and the FOMC and stuff like that. Let me just come back here. Like I said, let's head into sure, no problem. All right, so that's it, guys. Keep asking questions like that because that's fantastic. That's what we want to do. Let's get into the technicals. I do like to start with the equities first and take a look at those. Sometimes I go into bonds and things like that so we can look at interest rates. A lot of you might be trying to refinance your home again and again and again because we know that bonds have been moving up, which rates are going down. So it's interesting when you have the stock market going up and you have bond market going up. That's happened for quite a while. But the bottom line is that's the whole point, is what relationships are there out there that make sense to you that you're looking to trade. So here's the S&P 500. Let's go ahead and bring it up on a quick chart here. Let it update. All right, let's get it to a open, high, low, close. So let's just get it to our typical bar chart. And let's get it more than on just a daily chart. Let's move it out to about 6 months so we can see what's going on. This is key because this is actually leading into next week's webinar. I'm going to talk about trends today. I'm talking about support next week. Let me get it out to a yearly chart. So support after the March debacle over in Japan and the tsunami and everything like that was about 126 in the S&P, 1260 in the SPX, in the index. And lo and behold, here we are a couple months later coming down. We held at 126, and now we said we went up 127, 128, 129, 130. So in the S&P, we went from 1260 to 1230. 40 points to the upside over the past few days. And I've noticed that. I talked about that on my blog as well yesterday. Ahead of the Federal Reserve, it's like the markets like to run up, and they're daring Ben Bernanke. They're saying, Ben, make sure you're accommodative. Make sure you're accommodative for an extended period of time, because they're basically saying, if we're up here, we've rallied really hard, and if you don't say that, we've got a long way to go overall over the past couple of years. We could go down a lot and still be fairly valued. But on top of that, we went up 200 points on Monday and Tuesday, and you're speaking on Wednesday. So I've seen that a lot ahead of the Federal Reserve. It's like they're daring them to do anything else but say extended low rates for a long, that extended period of time, basically, or accommodative rates for an extended period of time. So 126 held. So as far as we're concerned on support for next week's or in 2 weeks when we talk about support, SPY is 126. We'll see if we're lower than that in 2 weeks. We'll see if this batch of data, economic data, purchasing managers data, is bad enough or good enough, obviously, to send us one way or the other. Obviously, if it's poor, we have a good chance of going below. So that's where the S&P is, just hanging in there, kind of, getting back in the middle of its range. 135, 136, 137 was the top. 126 was a low, and we're kind of in the 130, 129 area after today. Let's move into foreign currencies and take kind of a look and see what's going on there. And then we'll move into trends again. But like I said, let me pop back and forth and make sure there are no more questions. So again, as soon as you have a question, please chime in on that questions tab, and I'll make sure I get it answered. So overall, you know, like I said, volatility has been down a little bit, so there's been big international moves. A lot of you that live overseas that are trading during the European session, you're getting much, much bigger moves during the day than we are over here in America during our equity session for sure. So it'd be nice to probably move over to Europe and be trading over there and have a life instead of trying to be up all night, because that's not my style, is trying to trade all night and then try and go through the day all day long. So, you know, it's just like I said, it could be summer markets. The volatility is definitely low. The Federal Reserve is in there trying to do stimulus and things like that. So it is what it is. I don't go to work every day expecting to make trades. If the deer come down to feed, we strike, but I let the markets come to me no matter what I'm trading. On the other hand, if I'm playing defense and managing portfolios and things like that, I don't have the luxury of necessarily waiting. So if I get a little bit of a rally, I do put on protection and manage the portfolios and things like that. But that's kind of my fiduciary responsibility to be doing that all the time as we're managing money in a hedge fund type manner. So let's get into these. And I think we have to back out and kind of look at a daily chart of all of these and get a better handle of what's going on. So here's the pound. You have January and February and March, a little bit of a rally and right back down. So basically, if you look at January, we're in the same exact spot. So pretty sideways action for the most part. 160 maybe on the bottom. Maybe you can, you know, draw a line right across the top here, except for that one spike, something like that. You know, 163, 164. It's been a relatively tight range again. So that's what we have to be cognizant of it. So can we say that going into trend and going into tonight's discussion, can we say that the pound is trending over the past 5 or 6 months? Probably not. More range bound than anything else. There's been a bid to it, so we'll go into next week. We'll talk about support. So there's been some support down here in this area where we're at right now. So based on past performance, could you say that it has gone up? Sure, but that's why we have trading plans, because there's no guarantees that past performance is a guarantee of future performance. So the 159, 160 area has been support. Fundamentally, why was it support? You know, technically, why was it support? And so that's what we have to start to ask ourselves and create trading plans around it. So some of you day traders that aren't getting the volatility that you like, you could back things out and say, you know what, instead of going for 15 pips and hitting it with 20 contracts, 50 contracts, 100 contracts, maybe I back it out and do 3 contracts, 5 contracts, 10 contracts, and risk 50 pips, risk 100 pips, risk 150 pips. I'm going to lose the same amount of money. I'm going to go and try and make the same amount of money. I'm just doing it over days and days and days and days instead of 3 minutes, 5 minutes, 10 minutes, 15 minutes, because things aren't as active. So as a trader, you have to adapt a little bit and look for different opportunities. So based on past performance, could we say this is support? Absolutely. We could slice right through it tomorrow due to some international event or some speaker or some economic data, whatever it may be. But the bottom line is we are coming down into that support level. We've been trending down in the pound recently. Let's just take a look at the euro. Let's just do a daily on all of these. And then, like I said, we'll get into trend. Here's the euro. For the most part, looks pretty similar. A little bit more of a bid to it. January, February, March, April, we trended up, and we're doing a little bit better. So definitely a little bit more of a trend overall to the euro. So, you know, we could do some trend lines, that were in place that obviously have been violated, but until the past few months, we did something like that. Now, obviously, we know that Greece is going on in the euro, but overall, the euro region has done pretty well with the currency against the U.S. dollar. Let's just take a look at the Aussie, and here's some of your intermarket relationships. Here are those commodities. Have commodities sold off in the stock market for all of you that like to trade commodities and hold them in your portfolio? Absolutely. Well, commodities, if you're a commodity foreign currency, the Australian dollar, they go ahead and export lots and lots of gold. Well, they lost a little bit of value, 110 back on down to 105, so they lost about a nickel or so, but overall that trend is up. And just keep your eyes on this chart right here. And let me just bring in gold really quickly because it's worth looking at. And again, this is why I'm so big on these intermarket relationships and getting people to understand sectors and supply and demand, because if you hold gold bullion, if you hold a lot of gold, you might be able to use the foreign currency markets in your Australian dollar as a type of hedge where you say, hey, gold's gone up too much. I want to be a hedge. I want to go buy the US dollar against the Australian dollar for that hedge. So there's gold trending up and then sideways most of April, besides that spike, most of May, most of June. And here we are with going back to Interbank FX. Here we are sideways after that spike, April, May, June, looking very, very similar. So again, fast forward to next week, we're going to talk about support. Could we say there's support here right now? Yes. Could that break at any time? Absolutely. Let me go ahead and draw that a little bit better, please. That was kind of a messy trend line there. Could we say that it's going to work in the future? Absolutely not. Past performance is not a guarantee of future direction and performance or anything like that. So we've been kind of trending down and sideways, but we've got some support coming in there that we do see. What fundamental factors, what technically will get us to move? Who knows? That's what we're waiting to see. So we've been, as you can see here, are these big volatile days? Not really. They're getting smaller and smaller and smaller. These days are pretty big here, right around here as we came down and shot back up. But going sideways here, we're in a 105.35 to 106.35 range, basically. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. So basically 100, 125 pip range for 2-3 weeks. That is not super, super volatile. There are still plenty of good trading opportunities. You've got to adjust it to know. If you're looking for 2, 3, 4, 5, 600 pip moves, maybe you're waiting for something to cause us to do that. If you're looking to swing trade and day trade 10, 15, 20, 30, 40 pips, plenty of opportunity in there. Again, trading plans, risking the right amount. When does that happen? Does it happen when you're sleeping? Can't do anything about it. Does it happen when you're up and away? Take advantage of it. Let's look at one more currency and then we'll move on. Let's see. One more. Thank you. Good questions coming in. You're using Interbank FX Trader 4. There are so many platforms. Let's see. Is this your preferred platform, or so was it apart from the others? That's totally a different question, getting way off the subject tonight. I urge you to email me. I'll put that back up, and I'm happy to help people with brokers and tell them, the differences between them. But I think it's also a personal decision because everyone's looking for something out there. So if you're looking for a specific platform and reasons and bells and whistles, yes, I'm very educated on that, and I'd be happy to help. But that has nothing to do with tonight, so I'm not going to go into that. Please email if you have questions. Sorry, a bit new. What is support? Read the blogs and stay tuned next week for that. We'll get into that next week for sure. But that's a major term. I've actually done previous webinars on support, including them. So go back to the other webinars and take a look at some of them on technical analysis. Is the Australian US dollar going into compression or a pennant? Very good. I actually just saw that. Really good question. Let's take a look at that. So yeah. I think you want me probably to draw this trend line right here. And so overall, the trend in the Australian dollar is up. So we're talking about trend. Overall, the trend is up. Here comes what we call these continuation patterns, a wedge, a triangle, a pennant. I explained this actually in my class down at the University of Utah the other night when I was teaching, and I liken this to the letter P. So you draw your letter P up, and then you have your little circle at the very top. So it's kind of similar to a P. Bigger than that is if you understand price, always go back to price. Big move up followed by a small consolidation is usually followed by another big move up. Things can come in that change that. Fundamentals, raising, lowering if U.S. dollar starts to raise interest rates, does that take away some of that shine on commodities and the strength in the Australian dollar? Maybe. So lots of things can change it, but price-wise, big move up, small move down, and you should be followed by another breakout to the upside. Again, no guarantees on future performance, but you can see who's winning out here, sellers or buyers. The buyers are, because every time it hits 105.37, boom, we pop up. 105.37, pop up. 105.37, pop up. 105.37, pop up. So based on past performance, could you be bullish there and hope that it breaks out and it gets above this little trend line there, and then you're off and soaring? Absolutely. That's why we use charts, technical analysis, because it's fact-based data to tell you, hey, buddy, you're wrong. Hey, buddy, you're right. Stay in the trade, manage it, move your stops up, use the technology from the platform and your broker and things like that. So someone who asked about support, there you go. Support is where there's more buyers than sellers. Very easy to see that there are more buyers than sellers here. So again, that could change tonight, that could change tomorrow, next week, next month. That's why we have trading plans and risk management. And as soon as it violates it and starts to go down below these tails, thank you very much. I have my 100, 150 pip loss, but I was trying to gain 150, 200, 300 pips by hoping that eventually it popped up through here. And if not, if it doesn't pop up here, I'll be ready to take my profit up here and move my stop up and take it off. But if it surges, maybe I lighten up how many contracts I have, move up my stop, turn it into a trailing stop. Bottom line is use the charts to help you to manage the trade. One more that I just want to look at really quickly, another commodity-related one, is the Canadian dollar. Obviously, export a lot of energy, so it's my neighbor up to the north here as I'm here in the United States. So again, you could see strengthening in the Canadian dollar as the U.S. lost value, lost value, lost value, lost value. Commodities finally go way, way down, 10%, 20%. Oil goes down 115, 110, 105, 90, 93, kind of in that area we're at right now. U.S. dollar up, 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 up. Overall, though, trend down. Small retracement up. Are we going to have another trend down? That all is dependent on QE3 and that kind of stuff. If we said QE3 tomorrow, which way do you think that commodities would go? Stock market should go up because that's friendly for the stock market. Should, in quotations. More demand because things are getting better. That's going to get more people to have jobs and this and that. That's why we did QE2. So, hey, we need more energy. We have more demand for energy. People are going to conferences. They're getting into planes. They're flying. They're driving. So, hey, energy prices should go up. That means the U.S. dollar starts to fall again against the Canadian dollar as oil prices go up in value, as we weaken the U.S. dollar even more. Again, all of it, we don't know what's going to happen. We use the charts. We use fundamentals to tell us. We combine those two to get very, very good trading plans because there are no guarantees out there and things can change very, very quickly. So we're starting to see trends on a longer term. Let's just go in and change for 1 second and just go into trends for the short term. So thank you for that question on that compression, that pennant. Very, very good question because you're obviously paying attention to your charts and starting to develop reasons. But again, go back to combining those fundamentals, technicals to help gauge, your trade, to help you manage that trade. So let's just take let's see what, the Australian dollar was a great example of a trend today. I'm going to put this down on a 5-minute chart. Okay. So let me put my crosshairs up for you. So during the United States trading session, basically, the Australian dollar started to go up, 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 up. Bernanke spoke late, and then all of a sudden, late in the afternoon, as the stock market started to get ready to close, this is GMT time, so this is noon United States time, Mountain time, where I'm at. So noon Mountain time, 1 o'clock Mountain time, and then 2 o'clock Mountain time, moving that way, basically, as the stock market closed. So the trend was up, and then obviously due to some fundamental change, due to Bernanke, FOMC, whatever it is, stock market started to sell off, and the Australian dollar started to sell off hard. So the trend was down. The question was there something telling you why the trend was down? Was there a fundamental change in Bernanke's statement? Was it a relationship between equity prices diving? So the short-term chart here, within 5 minutes, 106.33, and then basically a half hour later or so, we're at 105.86. We almost lost 100 pips. That is a trend down. Again, we don't know what drove it. Guessing, obviously, statement and policy and things like that, fundamental news. But the point is that is a trend down. So who's making more money there? All right, and I have to be careful here because of compliance. Just if you measured the size of the move down from 106.33, let's just take one move at a time and move it down here until we had a little hiccup. We lost about 20 or 30 pips, and then we popped up about 10 pips. So if you just take measuring the moves, I'm not talking about trading, just measuring the moves, the move down was bigger than the move up. This move down was bigger than this little move up. This move down was bigger than this move up. So can you still make money going against the trend, which is a term we call fading? Basically, you're saying, I'm going to swim upstream. I'm going to go against the trend for whatever reason. The rubber band is stretched too far, whatever you want to use. Absolutely. You can make money going both ways. But I'm just talking about the actual size of the move. The moves down are bigger than the moves up, and that's what makes a trend. A trend is in place if you're going down when the highs are lower than the previous highs, and the lows are lower than the previous lows. So lower highs and lower lows. Let me go back to the PowerPoint so I can show you this. So for a downtrend, lower highs and lower lows. So we're looking at that on a one-day chart, basically intraday chart, so we're seeing that short term. Opposite would be your uptrend, higher highs and higher lows. So the Australian dollar had an uptrend earlier today, big move up, small move down, big move up, small move down, big move up, small move down, big move up. So at this point in the day, who's making more money just based on size of the move? Probably the buyers. If we just measure the size of the move, doesn't matter about where your location was and how much you were trading. Size of the move is bigger to the upside. Again, you can make money going both ways, and obviously if you have a very poor location, you can't make money at all. But the bottom line is if you were swimming in the right direction, basically swimming with the current, you were a buyer because the trend was going up. It obviously changed later. So there's your uptrend. This high is higher than this high. This low is higher than this low. This high is higher than this high. This low is higher than this low. And on it goes, and eventually trends stop due to technical levels, due to fundamental changes, whatever it may be. So technically it got too high, fundamentally things changed, and then we switched course and started to go down. So that is your definition of a trend, and that's it, seeing it on a intraday chart. Let's go back to the longer term chart for the Australian dollar. And in this move from here to here, who's making more money? Again, not talking about trading. I'm just talking about the measurement of the move. This move from, I got to move my GoToMeeting little webinar bar here. This move from the 90s basically up to 105 is bigger than the down move from 105 to 104 or 103. That's a fact, okay? That's a fact. Your trading location still has to be very important, all right? Because if you buy it at 105 and sell it at 103, that's not going to be a good trade. But if you buy it down here and ride with the trend for whatever reason, that hopefully is a good profitable trade. So the moves down, the sellers could make money, but they had to be very, very right in their locations because the move down was very small and very shallow. And then boom, we take off again. All right. So the moves up are bigger than the moves down. That's what makes a trend. Eventually, trends consolidate, and this may just be a consolidation. And we're not trending right now here. We're going very, very, very sideways. And eventually we're going to start a new trend. Are we going to trend down? Or are we going to pop up through this pennant basically here and trend up? For the trend up to really satisfy its higher trend, we've got to get eventually higher than this. We've got to go from this support level up, 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 and beat out 109 and 110 and be 111, 112, 113, 114. What would cause that to happen? Like I said, QE3, QE4, weaken the U.S. dollar, weaken the U.S. dollar, commodities go up, stock market goes up, and maybe the Australian dollar goes 106, 108, 110, 112, 115. If you're betting on that happening, then you're probably a buyer of commodities. You're probably a buyer of the Australian dollar. So that's a good look at a trend. And then this consolidation period, this choppy period where maybe swing traders and day traders are making out okay, but trend traders are having a tougher time on the longer term, and they're waiting it out because they've still made a lot of money. If you're a buyer down here and you're sitting up here, you've still done well. You probably moved your stops up and things like that, maybe taking profit. Maybe you're buying back in on the discount. But the bottom line is this is a strong trend up, and fundamentally it made sense because we were weakening our dollar and the Australia currency was strengthening their dollar. Let's see here. Another question, is there a method to consistently determine the current market trend? That's a good question, but it depends on your time frame. If I'm trading for the next 5 or 10 minutes, my trend is totally different than someone looking at 2 or 3 or 4 or 5 weeks of data or 2 or 3 or 4 years of data. So basically, the bottom line of the trend is which way is the markets flowing for your time frame that you're looking to be in that trade. So remember that's what I said is there's different styles of traders out there. You've got to look and see who you are and make sure you're looking at the right amount of information. That's why it's very hard for someone to come in and go to a lecture and say, I have a job all day long. I want to be a foreign currency trader. And then someone comes in and says, I'm a day trader. I do this, 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 this. And they go, ooh, I'm going to do this, 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 and this. And then they start staring at the computers because they realize this guy's a day trader. I'm going to emulate him. They're at work and they get fired. Or they try and fit all of that guy's day trading of 6 or 7 hours in a day into their half-hour lunch, and they try and make a trade, and they have no idea what they're doing. They just say, I'm going to make a trade in that half hour. That's when people overtrade, force trades, have no idea why they're making trades, and that leads to obviously 50-50 success at best. Is there a preferable time frame to determine market direction trend? I think I just talked about that. It all depends on who you are, because you're saying, wouldn't 5 minutes be too short of a time frame to call the trend? Not for someone who's trading for seconds at a time. And in 5 minutes, let's see if the Australian dollar here, on a 5-minute bar, if it moved in a 5-minute bar, let's see, and Bernanke said something that caused me to be bearish, and I saw it going down and breaking support levels. If it went from 106.33 to 106.14, that's 20 pips or so, and I'm trading 100 lots or 50 lots or 30 lots, and I need 2 or 3 or 4 or 5 pips to go my way. Well, as soon as Bernanke says something, to me that sounded bearish for the Australian dollar. I sell the Australian dollar, and 2 or 3 or 4 or 5 pips I buy it back. Could someone do that who has a full-time job? Absolutely not. Okay, so again, you have to figure out back to basics. Who are you? But 5 minutes is plenty of time to make money and to assess this is a new trend. I now want to be a seller, but I'm saying that because of something told me that. All right, whether support was broken, whether I see a chart pattern like a double top, whatever it is, I'm starting to use multiple things to tell me that. I'm not just looking at one bar and saying, "Oop, they went down, that's a trend." I'm using much, much, much more information than that. Okay, very, very good question though. So let's just get back into this and just kind of do a quick review as we're getting to the end. All right. So we talked about the macro events. There you go, quantitative easing, FOMC, stuff like that. Maybe micro events, maybe stuff that's focusing on one currency like unemployment data here in the United States, or if you're an option trader looking at earnings event on a company like RIM or whatever it may be for earnings period. So those micro events that may affect just your trading entity, whatever you're looking at. Technical analysis. We did bring in, obviously, trend in a big way tonight on short-term and long-term views. We did bring in support, which is my lead-in for 2 weeks from tonight when we talk about support. 4 weeks from tonight, we'll go over resistance in detail. Again, the Interbank FX webinar series that I'm doing here, I've talked about trend and support resistance in the very first few webinars way back in the end of March and April. So I've covered these in detail. So the person who said, "Hey, I'm new, what's support?" Go Google it, read about it. Go ahead and find some education on support. Read my blogs, which I'll show you in just a moment, and then stay tuned in 2 weeks, obviously. But you can get, every time I've had a webinar, I've introduced support, and obviously we looked at support as the floor. If you're standing on your floor, that's support. If you break through your floor, you're going to fall to the floor below you. You just broke support. So who won? The buyers or the sellers? The sellers won because they made the price go lower. Intermarket relationships provide trading edges. Again, if I'm protecting a portfolio, if I'm hedging against inflation or my business costs, if I'm a trucking company. We talked about the Australian dollar. We talked about them exporting lots of gold and how that looks a lot like the gold charts and the gold futures charts if you're some of those option traders. That's and equity traders and holding those in your portfolio. That's what I'm huge on, is making sure that my traders understand these, because I have to interview them. I have to find out where they're sitting at, where some of their big, if you will, quote-unquote hickeys are, or their detriments because they're not protected here. So that's my job, is to teach them these relationships that can help them sleep better at night, help them be profitable in these volatile markets and things like that. We talked about the definition of a trend, those higher highs and higher lows for that uptrend, the lower lows and lower highs for the downtrend, and went through examples. Next webinar, 2 weeks from tonight, July 6th, 2011 at 9 p.m. Eastern. Again, same thing, fundamental analysis catch-up, technical analysis. We'll talk about trend, support, and resistance. We'll bring in those intermarket relationships, but we'll go into support in detail. Maybe that Great British Pound is sitting there at 159 still 2 weeks from now, and we can use that as our support level. Education and recordings. Use your broker. Interbank FX has the education section there. They've also got a new site where I'm writing, Raggy is writing, who does some great education. I know a lot of you guys have heard of her. So Daily Forex Trading Edge is where I post my blog for the most part, or a subset of my blog. My blog is on financebanter.com/category/forex. So that's my personal blog there. You can go there. And then someone was asking about the videos. Just go to YouTube, put in Interbank FX, or Google, or search for Interbank FX, search for Back to Basics. All of my webinars are titled Back to Basics, and they're all on there. This one should be on there in about a week. Let me just quickly go back to my email. Some of you have questions about brokers and platforms and things like that. I'd be happy to answer those questions. So there is my email, and I'll just give you a quick snapshot of my blog. So this is yesterday's post. This is that financebanter.com website, and you can see here this is yesterday's commentary. Like I said, a lot of this shows up on the Daily Forex Trading Edge, which I have pulled up here, I think, or I had it pulled up here. So You can find that on the Interbank FX website, but you can also find that here at Finance Banter. So right there is yesterday's article. So let me just check in and see if there's any last-minute questions. You guys know how to get a hold of me. Looks like that was it. So great job, guys, paying attention tonight. Great, bringing in your participation. That's how this works. If you guys participate, and I can start to answer some of your questions. So again, please feel free to email me. I look forward to hearing or seeing you guys in 2 weeks, and stay tuned to the blog in between now and then. Have a great evening, guys. Thank you very much.